Hello everyone, welcome to Stock Bars Reality Show. We as Stock Bars, we believe that doing something with our friends is a lot more fun than doing it alone. It's not just about the money, it's about the experience. And so follow us on YouTube, Instagram, so that we can share this passion together.
Perfect. So today we'll talk about two different things in our episode. It is pretty action-packed, so we're going to be talking about REITs and ETFs and their differences and their pros and cons. And it will get you a good idea on both of these concepts. So before we can start, we can also introduce ourselves. My name is Max. I specialize in long-term investment and portfolio management.
My name is Gab, and I specialize in short-term trading.
Perfect. All right, let's get on with the show.
So first we're going to talk about ETF. So an ETF is an exchange-traded fund, which means that it is traded as a daily stocks, as a combination of many stocks on the stock exchange. It's not as a mutual fund that you probably know about. In mutual fund, there's only a price at the end of the day. So an ETF, I think, is a lot better. So you can buy it during the day, you can trade it, which I like personally because you can day trade it, you can short term trade it. So there's a lot of stocks. The fees are low. It's below 1% usually. You can get them for 0.02%, which is really good. And if you have a lot of stocks together, it means you just don't have a lot of risk.
All right, so do you want to talk about maybe an example so they get the general idea about the ETFs?
Yeah, sure. Well, let's first talk about crude oil, because I'm a big fan of crude oil. It's been down a lot. It reached about $50 a barrel. Right now it's at $54. Before a few months ago, it was at $75, which is a lot. And so I think it's going to recover a lot. So I think it's be interesting to talk about an ETF about crude oil. I've been looking at Oilu. It's a ProShare Ultra Pro 3 times crude oil ETF. You might think, what is that? But I think it's like a very good investment because this ETF has 3 times the return of a normal ETF. And because it's crude oil, I believe it's really safe because, as we've seen, the price can only go up.
Okay, so basically it's at a pretty low point. That's what you're saying at the moment. So over the long run, you can see that if you put it at its maximum, you see it has pretty much been uptrending. So this could be a pretty safe investment if you would aim for the long run because of the pullbacks that we've got from the recent downtrending from the October. Now we can hope for a recover, like you mentioned before. So that's the ideal case scenario. So you see value because why exactly?
Well, oil, we always need oil.
Mm-hmm.
And so...
Okay, yes.
Like,
yeah, you need
it's
the oil.
it's pretty obvious, I find.
Yeah, exactly. That is true. Okay, that's interesting. Perfect.
So to look up ETF, you just search on Google, list of ETF. There's many of them. I think Vanguard is one of the main ones as well. Vanguard just has a lot of ETF you can find, and their management fees are really low. I was looking at a Vanguard ETF. I think it's Vigro, and the management fee is 0.02%, and it's basically a combination of the Canadian Stock Exchange and the US Stock Exchange. So it's just very good because it's very safe. So because you're just going to get an average of both.
Okay, so if we just do a quick resume of what you just said, ETF is just very good. If you want, you should at least get about 30 to 40% of your portfolio in general should be a lot of ETFs, just for the single reason that it is a safe choice.
Right.
So you want to for sure solidify your portfolio with a good part of your portfolio with ETFs because they are low management fees. So most of the income that you get from the increase of the ETF, you get it basically all of it, right? Because there's no management fees like you mentioned, so it's very low.
It's very low management fee.
Okay, and it's low risk, so those
Yeah.
are the best
Like,
reason why you should invest in
compared to like a mutual fund,
Mm-hmm.
like where the management fee is like 2%,
Mm-hmm.
when you get an ETF for 0.02%, like,
It's negligible, right?
like it's a no-brainer, you know.
Okay, exactly.
Like,
Perfect.
yeah.
Okay, that's cool. Okay, so that's good to know about the ETF. So if maybe I'll start talking about a bit about the REITs. So I did a bit my research on the
Wait.
REITs.
What does the REIT stand for?
So REITs is a real estate investment trust. So
Okay.
pretty much what it is, it's a dividend-paying stock. So a large company buys commercial properties and real estate, like for example offices, shopping malls, and warehouses, and they do all the management. So what's cool about it? You're able to buy commercial real estate without having the trouble of actually managing it. So
Alright.
you can be an owner of real estate. Just think about that. It's crazy. You can be an owner of real estate and without having the hassle of actually managing it yourself. So I think that's absolutely crazy.
Okay.
So the most common real estate is pretty much the retail, residential, office, healthcare, and mortgage. So those are the most common that you can invest. So you can definitely look up whatever is your better fit for you, I would say.
Yeah.
So whenever you're looking up REITs, what you're looking for basically is definitely you're looking at dividend yield. So what is the percentage?
What's a good yield for a real estate investment trust fund?
Well, it depends, right? It depends on your objectives and everything. But in general, you're always looking higher than 5%, right? Yearly yield. But
Right.
you want to, the best case scenario would be close to 10%, right? Like
Those are very rare though.
those are very rare. That is true. So you're going to have to do your digging for sure. But we've picked out here a REIT actually just to share with you guys. It's called Nexus. So Nexus Real Estate Investment Trust. So this is traded at US in the market and
It's Canadian.
Oh, it's Canadian. Sorry
Yeah,
about
it's
that.
on the Canadian exchange.
Yeah, that is true. Okay, so even better because the Canadian dollar is much lower than the US. So, for example, this one has specific yield of 8%, which is actually very, very good considering this one. What's cool about it? It trades at 2, like I mentioned. But what's cool about it is that even though it will fluctuate, you will always get your 8% back each year. So this is why it's such a good thing to have a big percentage, not a big percentage, but some of your portfolio must have some REITs because, like I mentioned, they are dividend paying stocks. So that's what's really good. So you're getting a good portion of your money back each year, 8%, which is guaranteed, which is amazing, right?
Yeah, because if you can get 8% every year, for sure, like that's probably the best thing you can do.
Yeah, of course.
It's for sure with compound interest.
Mm-hmm.
And the other day I was talking to one of my friends. He was talking to me about DRIP.
Mm-hmm.
So DRIP is a dividend reinvestment
Program, I think.
Yeah,
That's
program. Yeah, that's it. So that's with TD Bank. I'm not sure with the other banks, but what it does is that it reinvests the dividend that you get from the
dividend paying stock.
Yeah, and it reinvests it as with no commissions.
Okay, so you're saying that all the dividends that you get from investing in one stock, they get reinvested in that stock and you pay no commission. So that's amazing. So that means that you're getting compound effect from just holding the money inside a REIT.
That's it.
Which adds so much value to that REIT, right? Because that REIT, not only did you you're getting 8% dividends per year, but you're also getting a bit more technically because that amount of dividends are getting compounded over the long term.
That's
right?
it.
So
the dividends are always going to increase. You always can get more dividends because these dividends are
reinvested. Yeah, that's amazing. That's really cool to know. Okay.
Yeah.
So if I keep going with what I was saying, so what do you need to look for whenever you're buying REITs? You need to look for dividend yields, capital appreciation. Those are pretty much performance factors. You need to look at strong management and a lot of experience. Basically, quality real estate. That's all you're really much looking for. and look for economic stronghold. So basically, what I mean about that is you need to look at where the economy is growing. So if the economy is growing, for example, you want to buy real estate in Washington,
Right.
or just New York, for example, where the economy is growing heavily, or compared to another city or a state where the economy is growing slower, basically. So you got to take that into consideration. So if we're talking about the pros and cons, pretty simple. So whenever we're talking about pros, REITs have to pay 90% of their income to their shareholders, which means that's the reason behind the high dividend. So also there's professional management. So that's a pro because you don't need to manage it yourself. So people that actually are good in the domain manage the REITs. So
Yeah.
that is very good. Also, some of the REITs are registered with the SEC, the Security Exchange Commission, which gives you a lot of transparency to the information that they have to give you. Basically, they detail the truth. The cons in general are lack of diversification because you only focus on real estate and you are missing out maybe on other opportunities. And also there's slow growth in general compared to maybe some stocks that have more potential. And since they are also taxable because whenever you get dividends, that means that you're getting income and you get taxed on income basically. So those are the pros and cons of REITs. I don't know if we have...
How much... So let's say my portfolio. I have ETFs, I have stocks, I don't have REITs yet. Like, what's the percentage of my portfolio I should allocate to REITs?
Okay. Well, in general, it depends on your strategy, right? If you're more an aggressive trader or a long-term trader. So if you are thinking you want to make quick profits or over like a short-term, maybe 5 years or something like that, to buy a house, to save up for a car specifically, maybe allocate a bit less into ETFs, more in yields, REITs, exactly. So you can get those cash dividends and reinvest them over time. So you're getting more money over time. That's for a short period of time. But if we're talking about long term, ETFs are definitely the way to go because, well, I would go maybe even like 50, maybe between 45 to 65% easily on ETFs because if you're saving up for when you're older, well, definitely those are the way to go because it's just good management. It's a lot of stocks, so the risk pool. The risk is spread. Sorry, that's what I wanted to say. And you're getting low management fees, and you're getting a lot of income back. So in general, it's 10% per year. So
yeah. So right now I have I think about 20% ETFs in my portfolio. I'm thinking about like putting maybe at 30-40% on REITs because I want just this 8% for sure, which I love because with compound interest, that's amazing.
Okay, you're talking about the 8% dividend yield?
Yeah, I love that.
Okay, that's amazing. Yeah,
I'm sold on that.
Yeah, you're sold on that idea.
I want that 8%.
And you definitely want to use the DRIP
yeah, that's it.
program because it's absolutely crazy just to think about how that works exactly. So,
right.
Because the problem is you always have to pay the commission to your broker to get in there, get out of buying stocks, and this basically negates that, which is absolutely amazing.
So just to wrap it up, we've talked about a few ETF REITs that you could look up. We'll put it in the description below so that you can look them for yourself. You can evaluate and take a decision, but we definitely think it's a good idea just to have a good look at it and consider them.
Don't forget to never invest on what other people's opinions. So please build your own opinion. This is our personal opinion. So it's we're just giving you guys ideas and some tips of what we learned from our from school and our experience in general. So basically that's what we wanted to say. So if we want to wrap it up, just mention a quick recap on ETFs and REITs, and then we can close this out.
Yeah. So ETF, exchange traded fund, low fees, a lot of stocks, and it's just a good idea.
Just for long term, right?
Yeah.
Right?
Or even trading.
Just trading in general.
You can trade them, you can buy and sell.
You can also trade them. Okay, perfect. Yeah. REITs, So real estate investment trust, so you can own real estate even though you don't need to manage it. So that's pretty cool. You need to what do you need to look for in general? A lot of yield, good capital appreciation, strong management, and economic stronghold. So those are pretty much the recaps. So if you're missing out, you can just look at the video and all the description. We will write all the everything we talked about, and you guys can see it for yourself.
Thank you for listening, and we'll see you on next Monday.